MMTs, good morning, 8 o'clock a.m., actually 8:04 a.m., 3/11/2012. How about that? S&P 500 index, call and put side, open interest, different levels that we're looking at. Right now, we're taking a look at this 1350. There's 143,000 open, okay? So at the different levels, like here's a 1375, and you can see the day volume. And look at here, they were buying the 1380s up and out of the money, MMTs. Most importantly, look at that 1400 strike, 25,000 contracts over traded right there. That's the big one. So what we're going to do is take a look at where these volumes are, where the uh, upper end of the resistances in the S&P 500 relative to the prices over here in the open interest. We're looking at things in they have big open interest here, 125,000 contracts at the 1350 put and 19,000 traded right here. That's this column. And they're monthly. And they expire next Friday. And today is Sunday, 3/11/2012. Gathered with MMTs, taking a look at the certain type of mathematical imbalances between the calls and the put side. And so, one thing that we will cover is why we are looking at these options, and I will build the market minders. We will be using the SMF platform, which is this one here in the video. You can clearly see that we're coming to major tops. And a week ago, last week, we had a bull exhaustion high. And we had talked about how those highs would get put in, and then you would have that immediate reversal, as we did. And you could see on a 5-day level, though, if you go from where this point, right before this daily gap down, you can clearly see on a daily level the exact value, and our platform does not lie. And the diamonds show it, and you can see it, but then look at the turn. Bam, right back to the highs. This is a very sophisticated pricing script that when you got at the highs, those prices were exhausted at resistance. Now we are going to come back up and we're going to test these highs, and we're going to take a look at how to develop a call and put, both the calls and the put side of the market here on the S&P 500 index. Once again, the MMT platform will be used in the primary part of it so that the MMTs will know where those upper end of those resistance levels are going to be if we break these highs up here. We came right up here and we slid the bid right there, right back to that half delta line right there. And there's that bot. But look at that. Bam, the close on the high, the close on the high, and the close on the high. And that's a 3-day run. And that was the counter trend to the bull exhaustion reversal, meaning it needed a pullback. And then you came right back up to the half bar. You got above it, and you kept moving right back up to the resistance level. And you can see here that in bull runs, when you're in a price exhaustion area, two things will happen. You will have these wicks, and you will have the reversal bar that will look like this, MMT. And then again, the lower end would be a negative red, and they would be closing just like this down here on their diamonds. So in order for the S&P to get up to some of our price targets, which I will discuss, and some of those price targets are going to be certain price targets in the S&P. Now, here's our platform. So basically, I'm going to show you, and I'm just going to keep this much of it in there, right there. And you can see that we're coming up toward the highs of this major resistance level. And this is the true story. And counter trends within bull exhaustion reversals will remain to either break above, get higher in another exhaustion area where that intraday opening bell within the first 15 minutes would be a transaction as they would square those resistance levels. People would have a limit order out to sell short into the higher levels. And some of those levels that we're going to be taking a look at in our system is going to be 1378 on the S&P. That's going to be our delta range for Monday now. And today is Sunday, 3/11/2012. We're going to be looking at the 3 delta movement, that S&P upper end of that resistance level, and this will change every day, but right now it'll stand at 1394, and we'll be taking a look at the 31.8 handles would be 1402 at a full 4 delta range in that S&P. And you would have to break the tops to get to these levels I'm describing. However, the level that we're going to work with right away is, do we close above, let's say, 1382 on the S&P 500? And what would that look like? Well, what would have to happen, you would have to gap and hold above the daily bar, would have to be above this teeny line, and it would have to be another qualifier, and it would have to be a 1, 2, 3, and that's 3.5 delta movement times 6.63. Add that up. So that's what kind of bottom up trade these have been. So when you look at the gap sequences right here on this daily chart on the MMT platform, I gave you the upper end of those resistance orders that are going to be in your delta tree. One of the things you're going to be focusing on over here is this 1371, but let's take a look at this half bar. This half bar, it's a half daily bar now. That's going to be 1370.93, and we closed on the S&P 1370.87. Now let's go back to the MMT platform. Here it is, right up at those resistance levels. You can see clearly that when the diamonds ascend, that bull exhaustion has reversals, but in the bull counter trend, look at the depth of that and look at the moves. And now equities also did that off of their lower ends that were trading the leadership in the S&P 500 stocks. When they hit their lower support levels, then they too immediately did what? Break above those negative half bars like this right here. Look at that. See, and when you don't go lower, you find support level in indexes, but now we're going to find again why the upper end toward going up toward those levels that I mentioned is when you start getting up around that 1390 handle, 1385, and well, the things that I said in the video here. So the thing about it is, let's watch these diamonds here. You got to close above them, and you have to have a qualifier. You have to have another 3. You have to have 3 delta line breakouts. Okay, and they're half delta lines here, but they have to be done in patterns of 3 to qualify. See, 1, 2, and 3 it got up there, but still 1, 2, and it was coming right back up here off of the bottom. But it was already up toward the high end of the range. And then look at the next daily bar. Bam. So that meant the upside, notice how it diminished right here and sold. It sold off at the first pass right here on that wick. So what I'm going to do is, once again, I'm going to go back over here to all of the options. They still premium in it. I'm going to have to do this on a different video. This will be part one, leading up to the March monthly expiration. Not to mention, my friends, we'll be looking at the April, and we'll be looking at open interest over here in May. And what does that May contract look like? And where is the general public in the exchange model at, and how do they steal premium out of the calls, and how they steal premium out of the put options? And you know what I'm talking about. It's happened to lots of people. So if you've been one of them, you know what I'm talking about. They mark both sides of the market down. And we're going to take a look at the strategies. There's even a March 30 weekly right here. So once again, we're going to take a look at the Aprils as well, because they're very important prices. How to use indexes to support high risk trades. And what does that mean? It means that where is the majority of the public? Right here, you got 86,000 open at that 1350 put right here below the market. And these are the time frames that I want you to look at, and that is huge volume, because that means that that side of the market. But look at over here, you still have 83 over here now, but that had been rising. And look at down here, 50,000 to 16,000 over here. All right, it's where the prices are that's the important piece of it. So the thing about it is the daily volume that people are getting involved with. When you look at here was 6,700 contracts traded. Like I said, it was intraday volume, but look at over here, 1375, 4,900 puts moved in. And when you start looking at the other side of the market over here, well, you had 1,700 of them, but look it up here, 9,000 of the calls right at that 1,400 strike. Once again, learning how to understand bull markets now and bull exhaustion patterns. The first calendar year reversal pattern with that counter rally starting Monday. How to use puts and calls on the indexes and various other things. But it's all about how do I get wholesale to the risk of an overbought bull, and if I break my key resistance levels, then I'm going to get more overbought, and I'll take the long side to these overbought levels, but you have to be selling and selling short.